The stock market has always been a place where human nature is tested to its limits. Long before high-frequency trading, artificial intelligence, and instant global execution, the market was already revealing a timeless truth. Technology changes, but behavior does not. Fear, greed, hope, and impatience have shaped every boom and bust in history. In that environment, only a handful of traders ever truly understood what it took to survive, and even fewer learned how to win consistently. Among them, one name continues to echo across generations: Jesse Livermore. Livermore was not legendary because he was always right. In fact, he was wrong many times. What made him legendary was that he learned from his mistakes, refined his principles, and turned raw market experience into rules that still guide successful traders today. His principles were forged in real battles, not classrooms. They were paid for with losses, pressure, and psychological pain. That is why they endure. At the heart of Livermore's philosophy was a simple but brutal belief: the market does not reward opinions, it rewards discipline. He understood early on that intelligence alone meant nothing in trading. Many brilliant minds were destroyed because they lacked emotional control. Livermore observed that the market punishes those who seek excitement and rewards those who respect structure. One of Livermore's most powerful principles was patience. He often said that the big money is made not in the buying or selling, but in the waiting. This idea runs counter to the instincts of most traders. People want action. They want to feel involved. Livermore learned that constant activity was a sign of emotional weakness, not skill. He waited for the market to present clear opportunities, and when it did not, he stayed out. Another cornerstone of Livermore's success was his absolute refusal to average down. He believed that adding to losing positions was a form of self-deception. In his view, the market was giving clear feedback. If a position was losing, the trader was wrong. Adding more capital to a wrong idea only deepened the mistake. This rule alone separated Livermore from the majority of traders, both then and now. Instead of averaging down, Livermore embraced the opposite concept, adding to winners. But even this he did with extreme discipline. He never added impulsively. He added only when the market confirmed his judgment. This principle turned winning trades into great ones, while keeping losses small and manageable. Risk control was the foundation beneath all of Livermore's rules. He believed survival came before profit. Without capital, there is no second chance. He never risked a large portion of his capital on a single idea, no matter how confident he felt. Confidence without control, he knew, was simply arrogance waiting to be punished. Livermore also understood the importance of trend recognition. He did not try to predict tops or bottoms. He followed trends once they were established. This required humility, because it meant accepting that the market was always bigger than any individual. Livermore aligned himself with momentum instead of fighting it. When the trend changed, he stepped aside without regret. One of his most underrated principles was emotional neutrality. Livermore trained himself to feel neither joy in profits nor despair in losses. Emotional reactions cloud judgment. He treated trading as a business, not a thrill. Wins were expected outcomes of discipline. Losses were costs of doing business. This mindset allowed him to remain objective when others lost control. Livermore also emphasized the importance of self-knowledge. He believed that the greatest enemy of any trader was not the market, but himself. Impatience, overconfidence, fear of missing out. These internal forces caused more damage than bad analysis ever could. His rules were designed as much to protect him from himself as from the market. Another timeless principle Livermore lived by was selectivity. He did not trade everything. He waited for the best setups, the clearest trends, the strongest opportunities. He believed that concentrating capital in the best ideas was far more effective than spreading it thin across many mediocre trades. This focus allowed him to maximize gains while maintaining control. Livermore's respect for the market was absolute. He never argued with price. If the market proved him wrong, he exited. There was no need for excuses. This humility kept him alive in an environment that destroys ego-driven traders. He understood that the market does not care about explanations, only results. His principles also emphasized preparation. Livermore studied price behavior relentlessly. He observed patterns, reactions, and market rhythms. But once the trade was placed, analysis stopped. From that point on, he let the market decide. This separation between analysis and execution prevented emotional interference. Perhaps the most powerful aspect of Livermore's legacy is how relevant his principles remain today. Modern traders may use advanced tools, but they struggle with the same psychological challenges. Overtrading, poor risk management, emotional decision-making, these problems are timeless. Livermore's rules address them directly. Markets today move faster, but trends still exist. Human behavior still drives momentum, panic, and euphoria. Livermore's principles work because they are rooted in human nature, not technology. They provide structure in chaos and clarity in uncertainty. Livermore paid a heavy personal price for his market battles, but his trading wisdom remains invaluable. His rules are not shortcuts. They demand discipline, patience, and self-control. But for those willing to follow them, they offer something rare: consistency. In the end, Jesse Livermore's greatness was not in predicting the market, but in respecting it. His principles remind traders that success is not about being clever, it is about being controlled, and that is why, even today, his rules continue to guide those who seek not excitement, but mastery. The stock market has never been a test of intelligence alone. History is filled with brilliant minds who failed spectacularly, not because they lacked knowledge, but because they lacked control. Jesse Livermore understood this reality early in his career. He saw traders who could read balance sheets, analyze charts, and predict economic trends. Yet, they still lost money. The reason was simple and brutal: they could not control their own minds. Livermore came to believe that trading was, above all else, a psychological battle. For Livermore, the market was not an enemy to be defeated, but a force to be understood and respect. He believed that the trader's job was not to outsmart the market, but to align with it. This alignment required emotional discipline, patience, and self-awareness. Without these qualities, even the best strategies would fail. One of Livermore's core psychological rules was learning how to sit tight. This sounds simple, but it is one of the hardest skills in trading. Most traders feel the need to act constantly. Silence makes them uncomfortable. Livermore observed that impatience caused more losses than bad trades. He trained himself to wait, sometimes for weeks or months, until the market clearly revealed its direction. When nothing was happening, he did nothing. This ability to wait separated Livermore from the crowd. He understood that money is made during trends, not during noise. Traders who jump in and out of positions exhaust themselves emotionally and financially. Livermore conserved both energy and capital by staying inactive when conditions were unclear. Another crucial psychological rule Livermore followed was emotional detachment from money. He did not see profits as rewards or losses as punishments. He viewed them as feedback. This mindset protected him from emotional extremes. Traders who celebrate wins excessively become overconfident. Those who dwell on losses become fearful. Livermore avoided both traps by remaining emotionally neutral. Fear, in Livermore's view, was the most dangerous emotion in trading, not because it existed, but because it influenced behavior. Fear caused traders to exit winning trades too early and hold losing trades too long. Livermore acknowledged fear, but did not obey it. His rules acted as barriers between emotion and action. Greed was equally destructive. Livermore saw greed not as a desire for wealth, but as impatience for more. Greed caused traders to overtrade, overleverage, and abandon discipline. Livermore countered greed with structure. He set rules for position size, risk limits, and exits before entering a trade. Once the trade was live, he followed those rules regardless of emotion. Livermore also believed that confidence must be earned, not assumed. Many traders feel confident before the market confirms their ideas. Livermore waited for proof. He trusted price action over opinion, rumors, or forecasts. If the market did not move in his favor, he accepted that he was wrong and exited without hesitation. This willingness to admit error was one of Livermore's greatest strengths. Ego destroys traders. Livermore understood that being wrong was inevitable, but staying wrong was optional. He never argued with the market. He never tried to justify losses. He simply closed the trade and moved on. Another psychological principle Livermore lived by was focus. He avoided distractions. News, tips, and outside opinions had little influence on his decisions. He believed that the market's message was already reflected in price. Listening to too many voices only created confusion. By narrowing his focus, he maintained clarity. Livermore also understood the danger of emotional attachment to positions. Traders often fall in love with trades, turning them into personal battles. Livermore avoided this by treating each trade as temporary. He entered with the intention to exit, either in profit or loss. This detachment allowed him to act decisively when conditions changed. Losses were an inevitable part of Livermore's career. What set him apart was how he handled them psychologically. He did not try to recover losses immediately. Revenge trading, he believed, was a form of emotional instability. After a loss, he often stepped back, reviewed his actions, and waited for the next clear opportunity. This pause prevented small losses from turning into catastrophic ones. Livermore also emphasized the importance of self-honesty. He believed traders must constantly examine their motives. Were they trading because the setup was strong, or because they were bored? Were they holding because the trend was intact, or because they feared admitting a mistake? These questions were uncomfortable, but necessary. One of Livermore's most subtle psychological insights was understanding market timing. He believed that even correct ideas could fail if acted upon too early. Being early was often indistinguishable from being wrong. This realization taught him patience and humility. He waited for confirmation, not perfection. Livermore's mental discipline extended to his lifestyle. He understood that physical and emotional health affected decision-making. Fatigue, stress, and distraction weakened judgment. He valued rest, routine, and reflection. Trading, in his view, required a clear mind as much as a sharp eye. Another powerful psychological rule was accepting uncertainty. Livermore never sought certainty in trading. He accepted that the future was unknowable. His goal was not certainty, but probability. By thinking in probabilities, he removed the need to be right all the time. This reduced pressure and improved consistency. Livermore also warned against the illusion of control. Many traders belie they can control outcomes through analysis or effort. Livermore knew that the only thing a trader can control is behavior. The market will do what it wants. Accepting this truth frees traders from frustration and false expectations. His journals reveal a man constantly analyzing his own psychology. He tracked not just trades, but emotions. He studied his reactions to wins and losses. This self-study was a critical part of his growth. Livermore believed that mastering oneself was more important than mastering the market. Even today, Livermore's psychological rules remain painfully relevant. Modern traders face faster markets and constant information, but the same emotional challenges persist. Fear of missing out, overconfidence, impatience. These forces are stronger than ever. Livermore's principles offer a counterbalance. In the end, Livermore believed that winning traders are not fearless. They are disciplined. They feel the same emotions as everyone else, but they do not let those emotions dictate their actions. This distinction is subtle but decisive. Jesse Livermore's psychological rules were not designed to make trading easy. They were designed to make it survivable. And survival, he believed, was the first requirement for success. Those who master their minds may not win every trade, but they give themselves the chance to win in the long run. That is the real lesson of Jesse Livermore. Not how to predict markets, but how to think, feel, and act under pressure. The stock market has never been just a place of numbers, charts, and economic data. From its earliest days to the modern era of high-speed trading, the market has always been a battlefield of human emotions. Fear, greed, hope, regret. These forces move prices just as powerfully as earnings reports or interest rates. Long before psychology became a formal subject in trading education, one man understood a truth that most traders still struggle to accept today. Markets are driven by human behavior, and to master the market, you must first master yourself. That man was Jesse Livermore. Jesse Livermore is often remembered as a legendary speculator, a man who made and lost fortunes multiple times, but to focus only on his profits and losses is to miss the deeper lesson of his life. Livermore's greatest contribution to trading was not a secret formula or a mechanical system. It was a mindset. He understood that success in the market does not come from predicting every move, but from controlling one's own reactions to the market's movements. His principles, formed more than a century ago, remain painfully relevant because human psychology has not changed. Livermore believed that the market is never wrong, but traders often are. This idea sounds simple, yet it cuts directly against human nature. When a trade goes against us, the instinct is to defend our opinion, to blame news, manipulation, or bad luck. Livermore rejected this mindset entirely. To him, the tape, the pure movement of price, was the final judge. If the market moved against his position, it was not the market's fault. It was his responsibility to step aside. One of Livermore's most important psychological principles was patience. He often said that money is made by sitting, not trading. This idea is deeply uncomfortable for most traders, especially beginners. Action feels productive. Watching a position move slowly feels wasted time. But Livermore understood that the biggest profits come from major trends, and major trends take time to develop. The trader's job is not to force trades, but to wait for the market to confirm that a real opportunity exists. This patience extended not only to entering trades, but also to staying in them. Livermore observed that many traders are correct about the direction of the market, yet still lose money. The reason is psychological weakness. They take profits too early because they are afraid of losing what they have gained. Livermore considered this one of the greatest mistakes in speculation. Small profits, taken repeatedly, cannot compensate for the occasional large loss. Only by allowing winning trades to grow can a trader achieve long-term success. At the same time, Livermore was ruthless when it came to losses. He believed that losses should be taken quickly and without hesitation. This principle is emotionally difficult because it requires admitting that one is wrong. The human ego resists this admission. Traders often hold losing positions, hoping that the market will turn back in their favor. Livermore saw this hope as poison. Hope has no place in trading. The market does not reward hope, it rewards discipline. Livermore's approach to losses was deeply psychological. He did not view losses as personal failures, but as business expenses. Every trader, no matter how skilled, will experience losing trades. What separates winners from losers is not the absence of losses, but the speed with which they are controlled. By cutting losses early, Livermore preserved not only his capital but also his mental clarity. Large losses damage confidence, and a damaged mindset leads to even worse decisions. Another core element of Livermore's trading psychology was independence of thought. He warned constantly against following tips, rumors, or the opinions of others. The crowd, he believed, is almost always wrong at critical turning points. When everyone is optimistic, risk is highest. When everyone is fearful, opportunity is often near. Livermore did not seek comfort in agreement. He sought confirmation in price action. This independence required emotional strength. Going against the crowd is uncomfortable. It invites doubt and criticism. But Livermore trusted his preparation and his reading of the market. He understood that confidence must be based on evidence, not ego. When the market confirmed his view, he acted decisively. When it did not, he stepped aside without regret. Livermore also emphasized the importance of mental capital. Traders often focus only on financial capital, but psychological exhaustion can be just as destructive as a depleted account. After periods of intense trading, especially during volatile markets, Livermore would step away. He recognized that fatigue leads to impulsive decisions. Stepping back was not a sign of weakness, it was a strategic move to protect his mindset. One of the most misunderstood aspects of Livermore's psychology is his acceptance of uncertainty. He did not believe in certainty in the market. No trader, no matter how experienced, can know the future with absolute confidence. Livermore accepted this uncertainty and built his strategy around probabilities rather than predictions. He did not need to be right all the time. He needed to be right when it mattered most and manage risk. He was wrong. This probabilistic mindset freed him from emotional attachment to individual trades. Each trade was just one of many in a long career. This perspective is crucial for traders today, yet rarely practiced. Many traders treat each trade as a judgment of their intelligence or worth. Livermore saw trading as a business of statistics and discipline. Personal emotion only interfered with performance. Livermore also understood the psychological danger of overconfidence after success. Large wins can be just as dangerous as large losses. Success can lead to reckless behavior, increased position sizes, and a belief in one's own invincibility. Livermore experienced this firsthand during his life, and his writings reflect a deep awareness of this risk. He warned that the market has a way of punishing arrogance swiftly and severely. To counter this, Livermore relied on rules. Rules remove emotion from decision-making. They provide structure when emotions are strongest. His rules for position sizing, pyramiding, and loss cutting were not arbitrary. They were psychological safeguards. By following rules, he reduced the influence of fear and greed on his actions. Another timeless psychological insight from Livermore was his understanding of boredom. Many traders overtrade simply because they are bored. They feel the need to be involved in the market at all times. Livermore believed this behavior was destructive. Not trading was often the correct decision. Waiting for clarity, waiting for confirmation, and waiting for the right conditions required discipline and self-control. Livermore's legacy is not that he was always right. In fact, he was often wrong. His greatness lay in how he responded to being wrong and how he managed his emotions when he was right. His principles were forged in an era without modern tools, yet they remain applicable because they are rooted in human behavior. Today's markets move faster, information spreads instantly, and technology has transformed execution. But fear still feels the same. Greed still whispers the same lies. Hope still tempts traders to ignore risk. Jesse Livermore's psychology addresses these timeless challenges directly. He teaches us that the real battle is not against the market, but against our own impulses. In the end, Livermore's greatest lesson is simple, yet profound. Trading success is an inside job. Charts, indicators, and strategies are tools, but the mind is the true instrument. Without discipline, patience, and emotional control, no system can succeed. With them, even simple principles can lead to extraordinary results. Jesse Livermore's life was a reminder that mastery of the market begins with mastery of the self. His mindset, forged through triumph and disaster, remains a guide for anyone willing to face the psychological realities of trading. The market will always test human emotion. Those who survive and thrive are not the smartest, but the most disciplined.